VP for Finance for the Kellogg Foundation. She is a member of the American Institute of CPAs and the California Society of CPAs. Catherine is passionate about bringing Christian-based stewardship, philanthropy, and giving services to families and ministries. So, Catherine, why don't you go ahead and take it away?
Fantastic. Thank you, Megan, and greetings to everybody who's on this call this morning. We're happy to have you with us, and I promise you, Megan, you won't have to worry. I'm no joke teller, so you don't have to worry about screening away any jokes on this this morning. But I am very excited about sharing with you donor advised funds. They're personal giving funds. They're one of the most popular things that we do in my organization, and they're very popular all across the country. They're actually the fastest growing charitable instrument in America these days. So I'm going to cover three things in this time this morning, and I do encourage you to jot down questions if I haven't described something, or you want to know, more specifically how it works. Please do, and I'm willing to stick around as long as Megan's willing to keep the call open to answer any of your questions along the way. So I'm going to describe to you just exactly what is a donor advised fund. It gets nicknamed DAF, and so I'll probably refer to it as a DAF during this talk. The benefits and features, and then how to get started. Okay, so just what is a donor advised fund? Makes you think about this as your personal giving fund. It's like a one-stop approach to charitable giving. Like I say, they're called DAFs for short. They've got excellent tax benefits, and I'm going to describe that in a little bit more detail. It is the fastest growing charitable fund in America. There are donor advised funds that start at $5,000 or $10,000, and there are some that are in the hundreds of millions of dollars. And so they're very flexible, wide-ranging numbers of donations that go in. They can take gifts from you during your lifetime or gifts from your final estate. Can be all kinds of property. I'm going to spend a little bit more time describing that. Cash, securities, property like real estate, even business interests can be donated. The funds can be invested tax-free, which further increases your giving assets. And it can be then come your giving fund while you're living, but it can also continue as a legacy giving fund or a memorial fund after you pass away. So we're going to unpack that just a little bit more. So what do I mean by having a one-stop approach to charitable giving? Well, if you think about a donor advised fund and how you do your charitable giving now, you choose the charities you care about. You may be budgeting for amounts that you're going to do, and then you write checks or go online these days and do online giving to several charitable organizations. And you know just how many charitable organizations you've given to at tax time at the end of the year, because income all of those charitable gift receipts, and you're dealing with all of those if you're itemizing your taxes. Well, what's one of the neat things about a donor advised fund is you can consolidate that inside your donor advised fund, where the donations that you're putting in, actually you can do that 1 or 2 or 3 times during the year rather than the multiple numbers of checks you may be writing out. And then you ask us as the sponsor organization, or whoever that sponsor organization is, to distribute on your behalf to the charities that you have requested. Many families are using donor advised funds these days instead of setting up a private family foundation. In the introduction, Megan mentioned that I worked for large foundations. They were private foundations, and families still can set up family foundations these days, but they're more complicated. They're more expensive. I always kid that there's really nothing private about a private foundation. Everything has to be disclosed, including the gifts that you're putting in and the distributions you're sending out. And that's all available for public information. And family foundations do not enjoy as good a tax benefit as a donor advised fund does. And so let's talk about those tax benefits for just a minute. A donor advised fund, by definition, this is IRS definitions, a donor advised fund must be held inside a charity that has public charity status. And that's kind of a a wonky term, but when you give to your local United Way or to Red Cross or your local church or homeless ministry or a homeless shelter, those all have a charity status with the IRS that's called public charity status. And what that really means to you as a donor is you get better tax benefits. And when I talk about different kinds of gifts, I'll come back to that. But just keep in mind that tax benefits are much better when you're giving to a donor advised fund or other public charities than they are if you're giving to a private foundation. So that's been a big feature and a big reason why donor advised funds have grown in recent years. In fact, a lot of people who have a family foundation are now closing those and distributing all the funds into a donor advised fund because it's simpler for them, and their future giving that they put in is actually better tax benefit than what they used to have under their family foundation. Another neat thing about donor advised funds is if you're thinking about encouraging your kids and grandkids in generosity and charitable giving, you can actually include them as advisors alongside you while you're living, or you could have your donor advised fund continue according to whatever that sponsor's policies are. Our policies are that they can continue for up to 10 years after you pass away, where your children could come in and step in and be the advisors and continue then to shepherd, if you will, your legacy charitable funds by making decisions to give those away to charities according to either your instructions or allow them that, flexibility to make their own decisions. It's a wonderful thing to do as a family, to include family in all of that. It's a wonderful way to leave a memorial legacy, and you can actually make estate contributions into your donor advised fund by putting it in your will or living trust. So that's, just a little bit more unpacking about why donor advised funds are so popular, why so many people are doing them. And whether it's as simple as I want that one-stop approach, I want to make 1 or 2 donations during the year, let my sponsor organization handle the multiple charities. I get one tax receipt at the end of the year. And I like that, or all of these other features that can be incorporated in your planning. And because this is advice chasers, many of you are working already with a financial advisor. We come alongside and we can really help with the very specific charitable giving, working alongside financial advisors and other sponsors. Some of them do that also. So what are the benefits on this? And it's really that you can think about some financial planning for your charitable giving. You can use it for making lifetime gifts. Some people that we work with that are in their working years are building up their donor advised fund that they're able to donate more into it during their working years. So in a way, they're pre-funding for their retirement years. They've already got that money set aside, and they've gotten the tax benefit by donating in their higher tax bracket years. And so that money is available to them during their retirement to make charitable distributions. By doing it that way, it's the same way as if we have retirement funds set aside for taking care of our household. It's pre-funded. We don't worry about it when we're on a fixed income. Another benefit is we all know how to give away cash, but you can also give away appreciated assets as gifts. And when you do that, you get a second tax benefit. So think about stocks, securities, mutual funds that you may own, not in your retirement account, but in your regular brokerage accounts, your investment accounts, or your personal residence that you may have held for a long time that's built up a lot of capital gain. Maybe you've got a second home that you pay capital gains tax on when that sells. There's no exemption at all for that. Rental properties, some of these other kinds of things. If there's long-term capital gain built in, there's a really neat thing that you can do in giving appreciated property into a donor advised fund. And by giving that appreciated property directly to the charity rather than selling it first, charities don't pay tax. And so there's still capital gains built in, But when the charity sells that, they don't have to pay a capital gains tax. So in effect, you're saving it, because if you gave a $50,000 stock gift to a charity directly, they keep the whole 50,000. Whereas if you had to sell it first, you may be paying a $12,000 or $14,000 capital gains tax, and all that's left over is $36,000 or $38,000. So it's a huge benefit. It's another one of the reasons that we see it so popular, is that there may be reasons why, for tax planning purposes or financial planning purposes, you'd like to get that large charitable deduction, but you don't want to send it all out to charity in that year because it's big. It's a fund that you can use over several periods of time, several years. And so that's why people will use this for saving capital gains tax, getting a tax deduction, pre-funding, if you will, through a donor advised fund for the charitable giving you'd like to do for several years in the future. Once the money's in that donor advised fund, whether it's a cash gift or you've done that appreciated property gift, and in fact, we do a lot of real estate, we sell it. Well, now there's a big pool of money in this donor advised fund. Another neat benefit is that we can then invest and grow those DAF assets tax-free inside the donor advised fund. Why? Because it's already owned by the sponsor organization as a charitable fund. And so that all works as being able to invest in income gains, can all build up tax-free. That all becomes a part of the resources that you can then use to make distributions to charity. So it's really powerful when you think about the combination of being able to do financial planning in your higher income years. Think about if you had something that was creating windfall or larger income, a large bonus, selling a business, any of those kinds of things where you can have a large income in a given year, and you'd like to be able to do something to save taxes, but not have to give it all away to charity at the same time. So there's a lot of reasons why people will then look at that, and why then working with your financial advisor, working with someone like us at CFA, that we can help to coordinate all of that. Bequests from final estate, I made a brief mention of that. Many of us have strong charitable hearts and want to do something to leave gifts to charity. We may be doing a more modest amount while we're living, because we need to conserve assets for retirement, for health issues later on, thinking about inheritance to our kids and our grandkids, those kinds of things. But we'd like to carve out a nice gift to our church or favorite local charity after we pass away. And so a donor advised fund can also be named to receive a bequest from your final estate by putting that in your will or your living trust document. And again, that sets up, and in your donor advised fund, you can either leave instructions, we call them testamentary giving instructions, that you would leave with our organization or any sponsoring organization. Or you can ask your children to continue as advisors if you'd like to, children or grandkids for a period of time. So it's powerful that way also. It's a wonderful way to extend your family legacy, those things that matter most to you, into the next generation, including involving your kids or grandkids, which is fantastic. I'm a grandmother myself, thinking about teaching our kids and grandkids about the importance of generosity, of giving, of caring about the community and those around us, and helping those in need is a really important part of the values that we share with our family. And then it can also accept charitable distributions from, there's two kind of acronyms here, but there are also charitable instruments called charitable trusts. CRT stands for Charitable Remainder Trust. CLT, Charitable Lead Trust. Just know that if you are, and that's a whole nother subject for another time, if you're thinking about setting up either one of those charitable trusts, there's a distribution out of those trusts that goes to charity. That charity recipient can also be a donor advised fund. You don't have to think about naming an ultimate charity at the end, which again gives you a lot of flexibility. You have to hard code it in at the time you're doing it. With a donor advised fund, you have that flexibility to decide later on where it goes. Okay, so just how does it work from your perspective? And this this kind of illustration is I think a good way to to share that. Once your donor advised fund is set up and it's an agreement, and in our case, we've got a 2-page agreement that you sign as the donor and we sign as the sponsor. You make a gift at any time. And once that gift goes into your donor advised fund, remember that's housed at the sponsoring organization, which is a public charity. That's a completed gift to charity. And that's why you get that immediate tax benefit. Okay. Once it's in there, for the amount of money that's in the donor advised fund that you're not planning on distributing out right away, you have the option to have that invested, and those investments can grow tax-free. And I'll talk a little bit more about investments on a future slide. And then the third main thing that you do is you then become the advisor, and you're asking the sponsoring organization to make a grant distribution to the charities that you care about. So it's that simple. You make a gift into the donor advised fund, get a tax benefit right then. You have the option of tax-free investing so that fund can grow. Surplus funds can grow over time. You request a distribution to your favorite charities as an advisor, and those go out on your behalf. So it's that simple, and with all of those features we talked about. So let's talk for just a minute about making that gift into your donor advised fund. I'm going to just touch on this briefly. Don't have time to go into the details on all of this, but there's 2 aspects to giving, as you know. It's what to give and then how to make that happen. So obviously, gifts of cash are always welcome, always simple. I did mention giving appreciated property, and you can see I've listed here stocks, mutual funds, other securities. You would do that when you've held those investments for more than a year and there's capital gain built up and you want to avoid that capital gains tax. And so by giving that directly, you're getting that double benefit of no capital gains tax, plus the full fair market value of that stock or mutual fund gift is your charitable deduction. Very similar with real estate. So if you think about your family home, and you know, we've got, there is a tax exemption if you're single. There's a $250,000 gain exemption. If you're married, there's a $500,000 gain exemption. But in many parts of the country, even average homeowners, but you know, particularly in more expensive parts of the country, you've probably built up substantial capital gain in excess of those amounts, and you're going to have to pay tax when you sell your house. If you think about that with a second home, there's no exemption. You're paying capital gains tax on all of it. Rental properties, capital gains tax on all of all of that. And so by giving real estate, you can also avoid that capital gains tax. And I'll talk about that more in just a minute. Business interests, I'm just going to touch on the business owners out there. If you have a sole proprietorship, a partnership, an LLC, a private C corporation stock, anything like that, just know that there are ways to give business interest directly into your donor advised fund where there's capital gain built in. That takes more planning. It's more technical, but just know that, that most sponsoring organizations have the ability to do that. You can have your life insurance benefits go to your donor advised fund by naming them as a beneficiary. I do want to point this out. There are restrictions on IRA assets. We cannot accept IRA assets into a donor advised fund. The IRS says no. If you're going to give these retirement gifts that seniors can do directly from your IRA into a charity, it cannot go into a donor advised fund. So as a for instance, many donors know that they can do a qualified charitable distribution, and they may send it to their church or their local charity directly. If you have a DAF, just know that it can accept what's called that qualified charitable distribution. We do have an alternate fund at our organization. That's just something for you to check that fits the rules. So how do you do these gifts? It's just kind of go down this list quickly. The cash gifts are by check or bank transfer. I'm sure you're all used to that already. Once you have a donor advised fund, we have many donors that do kind of recurring. They sort of budget their charitable giving, so they can set up an automatic deposit in, which is kind of nice. With securities, most often it's by going to your broker or custodian and filling out the instructions for what's called an in-kind transfer. directly to the sponsoring organization, and the memo says for your donor advised fund. Real estate, this is interesting how this is done. And so you get the capital gain benefit by giving the gift in kind before it's sold. And so real estate gifts are completed by actually doing a grant deed transfer. So there's deed work that's done ahead of time and recorded before the property is sold and goes into escrow. The thing I wanted to point out on real estate gifts is very often people are interested in this benefit, but they don't want to or can't afford to give the whole gift of real estate. So what's neat about it is that you can be a partial interest. We're working on right now where the gift is of 24% interest in their personal residence. We worked on the budget, what they could afford to give, how much tax they were going to save, and we worked out that percentage. And so the deed transfer was a 24% undivided interest to us as the sponsoring organization in this case. With life insurance, and we all know this, that they have beneficiary cards or pay on death forms. You just simply include your sponsoring organization with the memo gift to your donor advised fund on that beneficiary form, and that will happen that way. If you have paid up life insurance, you can retitle paid up life insurance to the DAF while you're still living if you don't need that insurance anymore. And then for estate gifts, it's in the form of a bequest, which is simply including instructions in your last will or testament or living trust. There's a distribution section, and you may be listing family members or close friends in there. You just simply include the name of the sponsoring organization for your donor advised fund as part of the instructions. Okay. So I mentioned very briefly when we were talking about how it works that you advise the charity about donations or distributions out. Your role, you do have a role in the donor advised fund, and that role is advisor. And this is because the donor advised fund is legally owned by the sponsoring charity. Under the IRS rules, in order for you to have that completed gift and tax benefit at the time, there has to be separation between your ability to have total control of that fund. And so everybody has settled on that this advisory role is in place. And so what happens is once you make the gift in the donor advised fund, then you're requesting the sponsor to make a gift to the charity that you'd like to have. And then it's the sponsor's job to review your request to make sure that that charitable organization is qualified under the IRS rules. And we do that. We have a whole research arm here that researches charities to make sure that they're qualified as public charities. And then every sponsoring organization also has policies about according to their mission. And I just encourage you to take a little bit more time to understand wherever your donor advised fund is, what their policies are, what their mission is, and the kinds of charities they support. They may have policies on charities they don't support, and it's worth you taking a little time to figure that out. But the sponsor is obliged to hear your advice, but they have to act independently. They have to make their own decision based on that. Now, what I will tell you is, if you're interested in a donor advised fund, take the time up front to think about where you want to have it and talk to a representative of that organization to find out what their mission is, what their policies are, review with them the kinds of things that you care about, and ask them, right? I have a lot of families that call and ask, will you support this, that, or the other kind of charity or cause or whatever, and make sure that that aligns with your own sense of mission, policies, and values. And once that's in place, then you'll find that that's a very smooth process, and that advisory role works very easily. So as an advisor, once you're with your donor advised fund, you request distributions from your donor advised fund to specific charities you care about. And you can include others such as family members as advisors also. Let's say you've got adult children and you've said to them, you may have $50,000 in a donor advised fund, and You've allowed each of your 2 children to, you maybe donate $2,000 a year out of that. By telling the sponsoring organization, I've named 2 of my children as advisors, they could actually send in advisory instructions also, or you could have a family meeting, which is really cool. You as a family can sit down together and talk about what you want to do, and they can have their input, or, you can let them do whatever. It's just a neat way to involve families. Those charities do need to be IRS qualified public charities. They have to have public charity status. We occasionally get requests, well, can we send a check to my next door neighbor who's just, had a bad car accident or has cancer or something like that. Donor advised funds cannot make direct payments to individuals. Everything has to go through a qualified organization. Again, we can invest DAF funds tax-free. That should say following the sponsor's policies. If you had a favorite stock that you had donated, ask your sponsor, can I continue to hold that stock in my donor advised fund? Their policy may allow you to do that, may not. Some sponsors, and we're like that, some sponsors will work alongside. If you're already with a financial advisor on larger donor advised funds where you can actually keep your financial advisor on your donor advised fund and work that out. That's just something for you to, probe a little bit more specifically if you're thinking about a DAF. And then again, you can plan for your donor advised fund to continue after your death as a legacy. The technique we use is that we have a document that's called a testamentary advisory. That's a written document. We've got a template for that, but some of them are free form letters where our donors are letting us know what they would like to have happen with their DAF funds after they're gone. Some cases they're turned into memorial funds, permanent endowment funds. Some have a spending plan to spend out over 3 to 5 years. Others say, upon my death, please distribute to this list of charities immediately. But again, you have just a lot of flexibility. Okay, I made brief mention about investing donor advised funds tax-free. And this again it's really powerful, actually. It's kind of like how we give into our 401ks and IRA accounts, that we put that money in and it builds up tax-free income for all that period of time until we have to start taking it out. The difference with donor advised funds and IRAs is when we take the money out of our IRA for our own living expenses, IRS hits us with ordinary income tax, right? When we invest in a DAF tax-free and we distribute to charity, again, it's charity to charity. There's no tax paid ever on any of that. So it's a very powerful way to make an investment for charity in a donor advised fund that can build up tax-free, that can have stronger value later on.
Hey, Catherine.
Yes.
Do you have a minute to answer a question?
I sure do.
Okay, we've got a couple here. One is, can a donor request the DAF to contribute to a charity to satisfy a pre-existing pledge?
Yeah, the technical answer to that is no, but here's the technique that we use. What we tell that donor is go back to that charity and tell them that they have to cancel and tear up that pledge so that there's no existing pledge. And then they can come back. And once we have a confirmation of cancellation of that pledge, then they can come back and request a grant from us. And then we can go ahead and make a distribution, but we cannot send money that says in satisfaction of XYZ pledge. And the reason for that is the IRS considers your personal pledge as a personal obligation, and donor advised funds cannot be used for your personal benefit, which would be fulfilling your obligation. So the technique is when I do something like that myself with my donor advised fund, like I go to a fundraiser and they send out pledge cards, this is what you do. You don't say I pledge $1,000. You write down, I intend to request a grant from my DAF for $1,000. That takes care of the whole thing.
Thanks for that. That was awesome. There's one other question here. And that was, what are the hard limits on what is defined as a charity? Is it basically like any 501c3, or are there other types of organizations that can fit that bill?
So they have to be a 501c3 charitable organization, and they have to have public support status. And so that usually looks like their tax determination. They get a tax determination letter from the IRS. And we can review that, but there's also a website that's very popular and it's free. It's called GuideStar, GuideStar. Anybody can get a free account on GuideStar. And the other way you figure that out is you go on GuideStar and then you look up that charity. And when you get to that charity, there's a little section that says tax returns. And if you click on the tax return, that tax return will come up. If the tax return that comes up is a 990 or 990 EZ, it's a public charity. If it comes up 990 PF, it's a private foundation and we cannot give to that kind of an organization. So it's charitable organization and public charity status.
Got it. Cool. Thanks.
And that's most organizations, by the way. It's many churches don't really have the same kind of charitable status, but they do have exempt status, and churches are automatically considered to be public charities. We just make sure that they're valid operating church organizations. Okay.
Thanks,
Shall I keep
Kathy.
going?
Yeah,
Okay.
go for it.
So I think I was almost done with this slide, and we're almost done with the basic presentation time too. The investing thing, I would just say that the investing program is really best for funds that you don't plan on distributing to charity for a year or more. And that's just simply because, we're seeing it right now in the investment market. Investments kind of go, they on their way to up long term, they're bouncing up and down. And we just recommend that if you think you're going to spend the money this year, it's better just hold it probably in cash or money market. But it's that money that you think maybe you won't need it for a few years, 3 to 5 years at least. That's when the investing program can be valuable. You technically can. We just don't think it's a great idea to do it for short-term money. Okay. There are several investment options available, usually in a sponsoring organization. We ourselves have 2 distinct programs. We have funds that we have publicly traded funds that we have screened that are good. And we also have an active advisory relationship that we work directly with for our clients that don't already have an investment advisor. It's a smaller amount, but we also will work with your advisor for much larger size donor advisements, and check with sponsors to see if they do that or not. And their thresholds for working with your financial advisor vary some, but that may be an option for some. And in some cases, we'll hold donated investments. But some sponsors also ask them if they have programs for a wide number of funds in the marketplace, or if they have what's called pooled investments. We don't do this here, but many community foundations or charity sponsors of donor advised funds have internal pools, and so they may have 3 to 5 choices available. It's if you're thinking about a donor advised fund and an investing option, that's a question to ask to make sure you know. So this is the last slide, and this is just getting started. Donor advised funds are very simple to get started. There's a short donor advised fund agreement. Ours is 2 pages long. They're probably 2 to 4 pages depending on the organization. You simply sign and date it. You choose the name of your donor advised fund. Most of our families use their family name or some other ideas. You return that agreement to the sponsor organization. Your donor advised fund will be opened up by the sponsor, and that's it. As soon as you've signed that agreement and they say that your donor advised fund is open, you can make that first gift into your donor advised fund and start making grants to charity. So I think, Megan, that covers my presentation remarks, and I'm happy to expand on anything or answer any other questions somebody might have. And I'll stick around as long as people would like.
Awesome. Yeah, we do have a few questions for you.
Great.
So one of them was, how do we best handle giving from an IRA if not through a DAF? Can you say a word about that?
Yeah. So there's a couple of things you can do if you're, if that's your money for charitable giving. Clearly at as soon as you're able to take money out of your IRA, you can make a distribution to yourself and then turn around and make a charitable distribution to the charity that you care about. When you do it that way, it's obviously going to be reported as income to you. And then if you're an itemizer, you can do that deduction. And most people say, okay, well then there's really no difference. The reason why, especially if you're an itemizer, it's nice to, and if you're not an itemizer, it's nice to not have to do that, is because if our adjusted gross income goes up, that could cause our Social Security to be taxed, could cause our Medicare insurance premiums to go higher, could pull us into a higher tax bracket for other taxable income. So you can always take it out of your IRA, report it as income, do a distribution. That's one. The way that has gotten a lot of interest is what's called this charitable, qualified charitable distribution, where you can ask your IRA custodian to make a direct distribution from your IRA to a charity. And when that happens, you do not have to include that distribution in your adjusted gross income. Now, you don't get the tax deduction, you don't get to double dip, but at least it's not your adjusted gross income, which will keep you in a lower tax bracket. It can maybe reduce taxes on Social Security, definitely can avoid higher premiums on Medicare health insurance for higher income people. And so, and like I said, at our organization, we created a very specific designated fund type. Just know that's there because I'm not going to go into any more detail about it, and just ask a sponsoring organization if they have other features for that. The last thing you can do is, leave instructions in your will or your living trust for IRA assets to go to charity after you're gone, which is a great way to give to charity, because we know if our kids or grandkids inherit IRA assets, they're going to pay ordinary income tax on that. Where if that's given to a charity, the charity does not pay any taxes. So if you were thinking about, X amount of money for family and for charity, give it first out of the IRA to charity and last to family. Try to give family assets that are not subject to taxes. Hopefully that answers with some.
Yeah, no, that's very helpful. I do have another question here. Someone was asking, is there any time limit on how long the funds can stay inside the DAF?
Yeah. Again, that's going to vary by sponsor. Right now, there's no hard rules or guidelines in the IRS about donor advised funds, but the industry practice that's out there suggests that over time, your distributions out of your donor advised fund ought to be averaging like a 4 to 5% annual distribution. And the reason for that is the IRS doesn't want people just putting money into these funds and then not ever having it go out to a final charity. So they're trying to encourage that, to make sure it gets to final charity. We don't have that problem here. We see most of our donors are giving, somewhere between 5 and 20% a year out of their donor advised funds. Your donor advised fund can last indefinitely, can last your whole life. As long as at some point you're starting to make some distributions that are kind of like paying out income over time. And then after you're gone, if there's money left over in your donor advised fund, one of the options you have with our organization, and again, you check it by sponsor, one of the options you have with our organization is that you could convert that into a permanent endowment, or you could convert that into a 20-year giving fund or a 10-year giving fund. But it is possible to convert them into perpetual endowments while you're living or after you're gone. But if you do that, then just, get with the sponsor on how that all works.
Awesome. Thank you. I'm seeing a couple more questions here. One is, what type of fees should people expect on,
Yeah.
when they're putting money into a DAF?
Yep, good question. These days, I think most sponsor organizations don't charge you to establish a donor advised fund. There's nothing up front to establish the actual fund. And then there will be an administrative cost that can vary. And I've surveyed this multiple times over the years. It can vary from, I don't know, 0.75% a year up to 2 to 3% a year on the fund. As the fund size gets larger, most sponsors will have a lower fee amount for larger funds, depending on what the activity is. And so the average tends to run, I'm going to say, between 1 and 1.5%. That tends to be the average, but I've seen lower and I've seen higher. And then the other thing you can expect is if there's an investment program that's a part of your donor advised fund, that there will be the investment advisory costs that go along with that. So there's the administration of the sponsor to run the donor advised fund, make sure it's sound, compliant, you're getting the reporting, everything. If there's an investment program, there will be the cost of whatever that investment program is. And again, in our case, at least, it kind of goes along with whoever the fund advisor is. And there's also discounting for larger amounts for that. And then the third way that you would have costs with a donor advised fund is if you're donating more complicated assets like real estate or business interests. That's more complicated for the sponsor to manage also. And there will be additional costs for that. But we always quote that ahead of time based on what the gift is, so people know what that is ahead of time.
Well, that leads directly into the next question, which is, how does that work when you're, donating real estate or, stocks or things like that? Is the DAF like sending that directly over to a charity? Or, are you guys liquidating that and then sending funds to the charity? Can you go into that a little more?
So we usually are liquidating and sending money to the charity. But we can, if the donor asked us to, if they asked us to, accept the gift of certain stocks, or if there was an investment program, to send that security in kind or that asset in kind. I got to tell you, I don't see that because the charities want cash themselves.
Right.
You probably have a donor advised fund because the charity doesn't have the capability or the expertise to handle those kinds of gifts, which is why, organizations like ours exist, because there's more involved. I mean, your local, church or homeless center, or, a lot of those organizations, they're busy taking care of the services and the people they're taking care of. They do not have people on staff that know how to do this, which is why it's valuable to have organizations like ours, these community foundations that are out there, come alongside to do that specialty stuff. So I could only see that happening if there was something particular about holding that asset, and yet the donor wanted to get it over to that charity as a completed gift. And I would think the charity would want to have a say as to whether or not they accepted that gift or not, because they may not know what to do with it themselves. So the bottom line is, when we get assets, we sell them, we reinvest if they want them reinvested, and when we distribute to charity, we're sending cash.
Got it. Someone else asked, where can one compare fees and sponsors online?
It's just old-fashioned homework. The best thing I can tell you, like so many organizations, for-profit and not-for-profit, some of that they consider to be somewhat proprietary. I'm not aware of a service arm that regularly puts up the fee charts. I mean, I've done that research myself. I go out to website after website after website, and I look up fees and costs and write them down and compare them. So yeah.
Yeah.
That's old fashioned homework, I think.
Yeah. I mean, when I went looking for an organization to give this presentation, I found it difficult to find, a DAF that we could, talk to someone.
Yeah.
I'm guessing some people are going through a financial advisor or some kind of financial firm to find a DAF.
Mm-hmm.
Yeah.
Yeah, they are. And a lot of the financial advisors, the platforms that they're on, more and more, they have some kind of a charity arm that's
Mhm.
attached to them. But that's why I've made the comment that it's important for you, the donor, to think about what you want to accomplish with your charitable giving funds, how you want to be engaged with your charitable giving funds. If it's just simply the convenience of transferring from your investment advisory account into a DAF that's on the Fidelity charitable platform or something like that, and you're going to write checks out, that might be okay. But more and more, even those kinds of organizations are superimposing policies on the kind of charities they'll give to and they won't give to. And so it's more important today than it was even 5 years ago for you to understand what those policies are. What we find is charitable giving is very personal. It's intensely personal. And we also know through a lot of surveying work that's been done that 90% of charitable giving is local. And so this is just my encouragement to anybody that's thinking about a donor advised fund. There is a fulfillment of purpose, and there's actually a joy in charitable giving, to be engaged with your charitable dollars, to think about, find a really good local community foundation. We're obviously a Christian foundation. There are other kinds of faith-based foundations out there. Take this as an opportunity to let your heartstrings connect to your money decisions on charity, and find a charitable partner that you would love to have help you with your charitable giving over time. And that's the pitch I make for you, the donor, to find a charity that you can connect with from a heart connection, and let them come alongside you. They're eager to do that. They're eager to get to know you as a donor and help you fulfill your purposes.
That's wonderful. There's another question that I have that you've kind of touched on a little bit here and there. And that is, you mentioned an endowment. Tell us more about, putting that money in there and getting it to basically last forever and to continue to give to the same charities or the same types of charities.
Yeah. So this is one of those kind of legacy legacy things that are so important to many families. You're thinking about, the provisions and the blessings that they've had in their life and wanting to do something. I always counsel our families, when you're thinking about inheritance, which is such an important decision, how we pass along what I call values, wisdom, and resources to the next generation, to kids and grandkids. Consider the communities that our kids and grandkids are inheriting. What are we doing and what can we do to help make that better for the next generation? And one way to do that is consider an endowment, a permanent charitable fund that would be, let's say somebody had the capacity to leave behind a $1 million perpetual fund in an endowment with good sound endowment management. A perpetual fund like that could be giving anywhere from $50,000 to $70,000 a year in perpetuity. It can support the local homeless shelters. It can support maybe cancer touched that family and they want to, have something that's always fueling cancer recovery services in a local charity or cancer research or something along those lines. And so with donor advised funds, the way an endowment would be set up is that there would be instruction from you, the donor advisor, to eventually convert that into a permanent endowment. And when a permanent endowment is housed at an organization like ours, that's a public charity, that retains its charitable status. It can be invested in perpetuity. So now you can have a long-term investment program on it. And just the income and gains are spent towards charity. And so the principle of that endowment is protected. mean, the foundations I worked in my early career were large endowments. They were set up by, donors with very large money. And so, it can be managed to make sure it protects principal. The principal grows with inflation over time, that the income is what's used to fund the charities that you care about. And you include instructions on either the causes you want or the named charities that you want to have supported. But it's very simple to convert DAFs into endowments. And I'm sure most organizations have a policy for a minimum amount that can be converted into an endowment.
Wonderful. That's awesome. Let's see. I think that's the end of our questions.
Wow,
Unless
that was
anybody has
great.
any others. Yeah. Very engaging presentation. I really appreciate it, Kathy. Was there anything
Well, we
else?
appreciate it too.
Yeah.
Yeah, it's just delightful to be with you this morning, Megan, and all of your participants that are still on the line. I hope you enjoyed it, and we just say God bless.
Thanks so much. So, and on behalf of Advice Chaser, we're super grateful for your time and for your organization, that you guys are willing to come on and share this really interesting information with us. Thanks to all our attendees for joining us. You all can look for an email soon that has a link to the replay of this event. You're welcome to share that replay with friends and family and anybody you think would benefit from it. Here at Advice Chaser, Catherine, if you could forward a slide for us so we can see that.
There you go.
Last one. There you go. That's our website. We're all about helping folks to find financial advisors who are a great fit for their lives and their financial questions. Our matching service is free. Every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. And you can find out more by going to that website on the screen, advicechaser.com, clicking the link to find an advisor. So once again, to everyone here, thank you so much for attending, and we'll see you at another webinar soon.